how do investment advisors get compensated? How do they get paid?
There's different kinds, right? So again, if you work at a branch level, they get their base.
Like a salary?
Like a salary. And then they'll get their bonus, right? Bonus is driven by, how much mutual fund sales they make for the year.
Just mutual funds?
Deposits and mortgages,
okay.
etc.
Okay.
Depending on different positions that, it's different, right? So that's how bank employees get paid, right? Whereas on our end, we're fee-based. How we get paid is based on how much fees we collect from the clients, right? So obviously, if I manage a bigger portfolio, then the amount I get paid is bigger.
So it's usually a percentage of the portfolio?
Yeah, it's a percentage of the portfolio.
Okay. So it's not like a percentage of the trade you make or something?
Not for me, but some people, to your point, they generate their revenue through trades, right? So the more they trade, the more commissions they earn.
So they charge what, like a 1% for every trade or something like that, or?
It varies. But the point of it is, you'll find with those advisors is that sometimes they trade a lot more than they need to. So it gets to a point where, was it necessary to make that trade, or is it because you want to generate revenue? So I don't know a lot of people that still use that model, but the old school people use that model.
Is there any pros and cons of that model versus the model that you, like the other model?
Well, the pro is the client don't pay unless there's a trade. So your fees may be lower.
Oh, okay.
So the pro is that. The con would be, because the advisor will only get paid based on the transactions, there's a tendency that they want to make more transactions. So whether that's right, the best thing for the client or not, it may not be.
Okay.
Right, so that's the con. On my end, the pro is then I can make 1,000 trades a year or 500 trades a year. It doesn't affect the client's fee. It stays the same, right? It's still a percentage.
What's the cons?
Well, the cons would be you're paying that fee
regardless if
if I trade one time or 1,000 times.
Or I'm not saying this is the case, but what if the investment advisor is like, oh, the market's going up, I'm just gonna sit back and do nothing?
They very well can.
Wow, okay.
But in a good market, I mean, if that's their management style, they do nothing. They can only probably get away with a year of that.
Oh, okay.
Right, because a good market year don't go for 10 straight years.
Yeah.
Maybe you have one good market year, and then the following year you're going to see volatility. So you're going to have to start doing some work at some point, right?
Yeah.
If that advisor is just going to sit back and not do anything, they're going to have a hard time surviving the following year.
So like every time you make a trade, you'll let the client know, right?
Of course.
Okay, so like if the client's like, I wonder if my investment advisor is actually like doing any trading, and so like they'll be advised.
Well, you'll get trading confirmations, or you can go online and see it. Okay. So you know, and you get your monthly statements.
But even when the market is going up and really good, I'm assuming good investment advisors still make trades.
We do, because then, for example, if a company reaches a certain target price, we need to look at it and say, okay, has reached $100 now. Can it continue to go up to 120 or 130? Yes, we hold it. No, if it doesn't, then we need to sell it and then find something else.
Okay.
Right, so we need to evaluate whether that company is still a good hold.
Like optimal returns versus average returns.
Exactly. I mean, a lot of people, they just think about, we get rid of a stock on its way down, which we do, but we also get rid of a stock on its way up because it's reached its potential. Now we need to get rid of it.
And there's a lower probability of it to continue to skyrocket.
Yeah, then we look for a next opportunity.
You look for undervalued stocks.
Exactly.
And then I guess the client gives you advice on which stock to look for, or you tell the client which stock you should.
We tell the clients, hey, this is our strategy, this is what we're looking at, and I would say 99% of the time they just go for it, because if they know what to look for, they don't need me. They just DIY it.
Yeah, I see.